Welcome back to the Deep Dive. You know, for so many people, decentralized finance or DeFi, it really seems like this amazing promise, right? Financial freedom, being your own bank.
Absolutely. And the innovation, the opportunities, they're incredible. But there's always a but, isn't there?
There usually is.
And in this case, it's the less exciting part, taxes.
Yes, taxes. Because DeFi is moving so fast, but the IRS, well, they're often trying to apply these older rules, sometimes decades old, to brand new tech.
Which leaves a lot of gray areas. A lot of this is, like you said, sort of uncharted territory legally.
Exactly. And that's what we're diving into today. We want to try and demystify how DeFi and just crypto in general gets taxed. You know, capital gains, ordinary income, was not taxed even.
Right. The goal really is for you listening to get a clearer picture, stay compliant, but also hopefully keep more of what you've earned.
Because it gets complicated fast. A single DeFi transaction might be capital gains or it could be ordinary income. Things like borrowing, providing liquidity, bridging between chains, wrapping tokens.
Yeah, all those common activities can be taxed differently depending on the specifics. It's why some people say DeFi tax accounting is, well, some of the most complex accounting there is. Seriously intricate stuff.
Which means professional help is often a really good idea.
Very highly recommended, yeah.
Okay, so DeFi is the Wild West, taxes are the map. What's rule number one? The absolute foundation the IRS set for crypto.
The big one is, crypto is property. That's how the IRS sees it. Bitcoin, altcoins, NFTs, stablecoins, all of it.
Property, not currency.
Exactly. Not currency for tax purposes. That's the key distinction.
Okay, so if it's property, like stocks or art, how does that break down for taxes? What are the main categories?
So two main paths. First, capital gains tax. This kicks in when you sell or, dispose of crypto and make a profit.
And there's a difference based on how long you held it.
Right. Hold it for a year or less, that's a short-term capital gain. It gets taxed at your regular income tax rate. For 2024, that's anywhere from 10% up to 37%.
Ouch. But if you hold on longer, more than a year,
that's where it gets better. Long-term capital gains, the rates are much lower, 0%, 15%, or 20% for 2024, depending on your overall income.
So there's a real incentive built in there to hold for the long term. The tax code is kind of nudging you towards being a HO dealer, isn't it?
It definitely rewards patience, yes. And calculating it is pretty straightforward on the surface. Sales proceeds minus your cost basis.
Cost basis being what you originally paid for it, essentially.
Right. And you need to do that calculation for every single time you sell or dispose of crypto. Every single time.
Okay, that's capital gains. What's the other main category?
The second one is ordinary income tax.
Yeah.
This applies when you earn crypto rather than buying it.
So like getting paid in crypto or mining.
Exactly. Mining, staking rewards, getting interest, airdrops, getting paid for work, all that stuff.
And how's that taxed?
It's taxed based on the fair market value in US dollars at the moment you receive it. Again, using those 10% to 37% ordinary income rates for 2024. And crucially, that value, that becomes your cost basis if you later sell that crypto.
Okay. So the value, when you get it, sets the stage for future capital gains calculations.
Precisely. Which leads us to the concept of a taxable event. Basically, any transaction that could trigger either of these taxes.
And you're saying pretty much everything needs to be tracked. Every buy, sell, swap, even deposits and transfers, they all need to go on the tax return.
That's the guidance, yes. You need the records for everything.
Okay, that basic framework makes sense. Property, capital gains, ordinary income. But let's get into the weeds. How does this apply to what people actually do with crypto? Selling for cash, like US dollars, that's pretty clear, right? Taxable capital gain.
Yep, that's a standard capital gains event.
But here's a common trip up. Swapping one crypto for another, like ETH for ADA, or even ETH for a stablecoin like USDC.
Also taxable, every time. The IRS sees that swap as two transactions. You effectively sold the first coin for cash and then instantly bought the second coin with that cash.
Even if no actual dollars were involved?
Even if no dollars hit your bank account? It's a disposition of property, so capital gains rules apply. A lot of people miss that one.
Yeah, that sounds like a nasty surprise come tax time. Okay, what about folks creating crypto? Miners and stakers.
Right. For mining, those rewards you get, they're taxed as ordinary income right when you receive them, based on their value at that time.
And then if you sell those mine coins later?
That's a separate event, a capital gains event, long or short term, depending on how long you held them after mining.
And for miners, there's this hobby versus business thing.
Yes. Crucial distinction. If it's just a hobby, you report the income, sure, Schedule 1 on your 1040. But, and this is big, you can't deduct your expenses. Electricity, hardware, nothing.
Oof. If it's a legitimate business,
Then you report on Schedule C, and you can deduct those business expenses. Electricity, the mining rigs, maybe Section 179 or depreciation repairs, rent for the space, even home office deduction potentially. Big difference to the bottom line.
makes sense. What about staking, specifically proof-of-stake rewards for validating?
Yeah, the IRS gave some clarity there in 2023. It's ordinary income, but only when you gain dominion and control. Meaning when the rewards are actually available to you, when they're unlocked and you can sell them, trade them, do whatever you want. If they're locked up for a period, the tax clock doesn't start until you can actually access and use them.
Like money in a locked safe, basically. Taxed when you get the key.
Good analogy, yeah. Now, for general staking rewards, also taxable as ordinary income, but the IRS generally doesn't view staking as a business in the same way as mining. So deductions are usually harder to claim, often just treated as miscellaneous income.
Gotcha. And airdrops, free tokens landing in your wallet?
Generally, yes, taxable. Ordinary income based on fair market value when you receive them.
Is there a difference between getting points in some protocol versus the actual token airdrop later?
Good question. Yeah, the points farming itself, just earning points or reputation, usually not taxable. But when those points result in an actual airdrop of tokens you control, that's the taxable event.
Okay. And watch out for scam tokens.
Definitely. Those worthless spam tokens or shtick coins that just appear, they aren't taxable income, but sometimes automated tax software might pick them up by mistake and inflate your income. Gotta watch out for that.
Right. Okay, so if the basics are a puzzle, DeFi taxes sound like a maze inside a maze.
Huh. Yeah, that's a fair description. You've got transactions happening in multiple steps, funds moving between different wallets, different chains. It gets complicated extremely quickly.
Let's take a simple one first. Moving crypto between your own wallets.
Yeah.
Like from Coinbase to your personal MetaMask wallet.
Right. That itself is not a taxable event. It's like moving cash from your checking to your savings account.
But you said it causes headaches.
It causes major headaches for tracking your cost basis. Imagine you buy ETH on Coinbase for $2,000. Later, you send it to MetaMask, then maybe use it on OpenSea to buy an NFT. When you look at your OpenSea transaction history, it might just show ETH deposited. It doesn't know you paid $2,000 for it back on Coinbase. If you later sell something and get ETH back on OpenSea or sell that original ETH, the platform might assume your cost basis was zero.
So it looks like pure profit or income, even though it wasn't.
Exactly. Tax software can get tripped up by this too, mislabeling self-transfers. You need meticulous records to connect the dots yourself.
Okay, that's a crucial point about record keeping. What about bridging? Moving assets from, say, Ethereum to Avalanche.
Just moving the same asset, like USDC from Ethereum to USDC on Avalanche. Most tax pros agree that's generally not taxable. Again, like moving money between accounts.
There's always a but.
The but is if the bridge involves a swap. If you bridge ETH from Ethereum and it becomes AVDAX on Avalanche as part of the process, that's different.
How so?
The IRS sees that as a taxable swap. Like you sold the ETH for cash, then bought AVX. The conversion is the taxable event, not just the movement across chains.
Understood. Okay, any good news in DeFi taxes? What about gas fees? Those pesky transaction costs.
Actually, yes, some good news there. Gas fees can sometimes help offset your tax bill. If you pay gas fees as part of a taxable transaction, like selling crypto or swapping one coin for another, you can generally add that gas fee to your cost basis.
Which reduces the calculated profit, meaning less tax?
Correct. But importantly, gas fees paid for non-taxable events, like just transferring crypto between your own wallets. Those aren't deductible or addable to basis, only when tied directly to a taxable sale or swap.
Okay, interesting nuance. What about wrapping tokens? Like getting wrapped Bitcoin, WBTC, to use on Ethereum. Is wrapping BTC into WBTC a taxable event?
That's a gray area. There are basically two schools of thought, two stances. The conservative view treats wrapping or unwrapping as a taxable swap. Sell BTC, buy WBTC. The more aggressive view argues it's not taxable, it's just the same asset in a different wrapper, a change in form, not substance.
Which is it?
The IRS hasn't given specific guidance. So this is definitely a situation where talking to a tax professional about your specific circumstances is really important.
Makes sense. Similar situation for governance or utility tokens. You get them, that's ordinary income usually. But what about using them to vote?
Right, receiving them is typically ordinary income, but just using a governance token to vote on a protocol proposal, generally not considered a taxable event, like a sale.
But that creates a weird cost basis issue again, right? If you didn't sell it, What's his value in calculating future gains if you do sell it later?
Exactly. Another tricky spot. Conservative approach might assign a zero basis to the spent voting token. Aggressive might try to allocate basis. Again, consult pro.
Okay, let's dive into DeFi loans.
Yeah.
If I borrow crypto using other crypto as collateral, is taking out the loan itself taxed?
No. Just like a regular loan, borrowing isn't income because you have the obligation to repay it. So taking out the loan itself, not taxable.
But repaying it is. You mentioned that can be tricky. Why?
Because you're usually repaying with crypto, and that crypto you're using to repay might have gone up or down in value since you first got it.
Ah, so repaying the loan forces a disposition of the crypto you're using for repayment.
Precisely. So each repayment triggers a capital gain or loss calculation on the crypto you used to repay. Finding the original cost basis of that specific crypto can be the challenge, especially if you acquired it in batches at different prices.
That sounds messy. Is borrowing stablecoins easier?
Generally, yes. Since their value is pegged, the capital gains calculation on repayment is usually negligible or zero. Much simpler accounting.
And the interest paid on these DeFi loans? Deductible maybe.
It might be, but typically only if the loan was taken out for a clear trade or business purpose, not just for personal investment or spending. Another area for professional advice.
Okay, flipping sides. What about the lenders earning interest in DeFi?
For lenders, the interest earned is taxable as ordinary income. Pretty straightforward concept.
But you mentioned a snag in reporting how much interest.
Yeah, the valuation is the tricky part, especially with volatile assets. Let's say Sarah lends 1,000 ETH and earns 2 ETH in interest over the year. But the price of ETH doubled during that time.
So is her income the value of 2 ETH when she technically earned it bit by bit, or the value when the loan was fully repaid and she received it, or some average?
Exactly. It's a valuation puzzle. Or dollars when actually received. Traditional finance doesn't usually deal with this level of underlying asset volatility in interest calculations. Again, professional guidance is key here.
And for borrowers, what if the market tanks and their collateral gets automatically sold off by the protocol? Liquidation.
That's definitely a taxable event. The protocol selling your collateral to cover the loan, that's treated as a sale of that collateral by you.
So you'd have a capital gain or loss on the liquidated crypto, even though you didn't click the sell button yourself.
Correct. Using that example, Jared put up UNI for a SO loan. UNI price drops, protocol sells his UNI. Jared has to report the capital gain or loss on that forced sale of UNI.
Wow. Okay, let's talk liquidity pools. LPs, staking, yield farming. People deposit crypto, earn rewards like fees or more tokens. How's that taxed?
This is another area where it can get complex. The rewards themselves and even the act of entering or exiting a liquidity pool can potentially be taxed as either ordinary income or capital gains.
Either. How can it be both?
Well, take John's example. He adds 10 ETH and 100,000 PP to a Uniswap v3 liquidity pool. He gets back a UniV3 NFT representing his position. Later, he exits the pool maybe with 15 ETH and 150,000 PP.
That NFT itself is unique and tradable, right?
Exactly. So one way to treat this. Option 1, view the initial deposit, swapping ETH-P for the NFT, as a taxable capital gains event. And exiting, swapping the NFT back for ETH-P, as another capital gains event. The difference is your gain loss.
Okay, what's option 2?
Option 2 treats getting the LP token or NFT as non-taxable, just a receipt. Then the extra tokens you get when you exit, the extra 5 ETH and 50,000 PP in John's case, are treated as ordinary income earned along the way.
Which way is better or safer?
Neither is definitively conservative or aggressive across the board. It really depends on your overall tax situation, your income bracket. Capital gains rates are often lower. So option 1 might be better sometimes, but maybe option 2 results in less tax overall in other situations. It requires analysis.
And this applies similarly to single-sided staking or yield farming too.
Generally, yes. The core issues around rewards and exiting positions have similar tax implications.
All right, last category in this DeFi maze. Leverage trading, margin, futures, options. Sounds like peak complexity.
You nailed it. This is where the need for an experienced crypto tax pro goes up, like tenfold. Lots of legal gray areas.
Okay, briefly, margin trading.
Borrowed funds aren't income, but if you use your crypto to make payments related to the margin account, that's a capital gains event, and any actual trades you make using borrowed funds also trigger capital gains tax.
Futures trading. Buying a contract.
Buying a crypto futures contract using crypto. Taxable event. Now, for regulated futures in traditional markets, there's a nice 60-40 rule, 60% long-term gain, 40% short-term.
But that doesn't apply to most crypto futures.
Correct. Because most crypto assets and their derivatives aren't regulated by the CFTC or SEC in the same way. So, no 60-40 benefit for most crypto futures traders. They usually face standard short or long-term capital gains rates.
That's a big difference for traders compared to traditional markets. A disincentive almost.
It can be, yeah. And finally, options trading. Buying an options contract with crypto. Taxable. Exercising the option. Capital gains event.
What if it expires worthless?
Then the money you spent on the contract is usually a capital loss, and selling or trading the options contract itself before expiration. Also a taxable event.
Phew. Okay, after all that complexity, let's get back to some simpler things. What transactions are definitely not taxed? Give us the good news.
Okay, the definite non-taxables. First, just buying crypto with fiat currency, like US dollars, not taxable when you buy. The tax cloth starts when you sell or dispose of it.
Right, just acquiring the property. Makes sense.
Second, like we discussed, transferring crypto between your own wallets or exchange accounts. Not taxable, but keep good records.
Okay, what else?
Just holding crypto, HODLing. Even if the value goes way up, if you haven't sold or swapped it, there's no tax due. Those are unrealized gains.
So you only pay tax when you lock in the profit or loss.
Exactly. Also, giving or receiving crypto is a genuine gift. Within the annual limits around $18,000 per person for 2024, it's generally not taxable income for the recipient and not a taxable event for the giver, though large gifts might require filing a gift tax return even if no tax is due.
And donating.
Donating crypto directly to a qualified charity like a 501c3 organization, that can be a great move. You typically get a tax deduction for the fair market value and you avoid paying capital gains tax on any appreciation. Win-win.
Okay, so those are non-taxable events.
Yeah.
What about strategies to reduce taxes owed? You mentioned losses.
Yes, this is crucial. You have to report your crypto losses. Don't just ignore them because they feel bad. Those losses can directly offset your crypto capital gains.
So if I made $5,000 on Bitcoin, but lost $2,000 on Doge.
You only pay capital gains tax on the net $3,000 gain. And if your losses are more than your gains in a year, you can deduct up to $3,000 of those net capital losses against your other ordinary income, like your salary.
And if you lose more than $3,000 net,
you can carry the remaining loss forward to offset gains or deduct against income in future years. It's a really important tool called tax loss harvesting.
Got it. So track everything, report everything, gains and losses. Okay, we know the current rules, more or less. But things are changing, right? The IRS is paying closer attention.
Oh, absolutely. They are actively ramping up enforcement on crypto tax evasion. They've invested in blockchain analytics tools. They're sending out warning letters. They can trace transactions.
And penalties aren't trivial.
Not at all. We're talking significant financial penalties, interest, and in cases of willful evasion, potentially criminal charges. Prison time is not off the table for serious tax fraud. They're not messing around.
And this ties into some big changes coming soon, right? For 2025, taxes filed in 2026.
Yes, very significant changes. Starting January 1st, 2025, crypto brokers, which includes US-based exchanges, and potentially will expand to include DeFi platforms and certain wallet providers, they will have to track your transactions.
Track them how?
They'll have to issue a new tax form, Form 1099-DA for digital assets, directly to you and the IRS. It will report your sales proceeds.
So similar to how stockbrokers issue 1099-B.
Exactly the same idea. This means your 2025 crypto activity will be reported to the IRS by early 2026. Many expect this to trigger a wave of IRS crypto audits.
The IRS will suddenly have way more direct data on people's crypto sales. It makes getting your house in order now even more critical.
Absolutely. And another change, also starting Jan 1, 2025, is a mandated switch to a specific wallet-by-wallet or address-by-address method for cost-basis accounting. This could complicate things further compared to the universal method some use now.
So more scrutiny, more reporting, new accounting rules. The message seems to be get compliant now, especially for past years, before this new regime fully kicks in.
That would be wise advice, yes.
Looking bigger picture, crypto is obviously not a fringe thing anymore. It's mainstream. Politicians are talking about it.
Yeah, you see presidential candidates mentioning crypto policy, things like making the U.S. a crypto capital, or even proposing a strategic Bitcoin reserve for the nation.
Which signals it's here to stay and becoming part of the broader economic discussion.
Definitely. And it highlights the pressure for regulators and lawmakers to create clearer, fairer tax rules that actually match how this technology works, rather than trying to shoehorn it into old frameworks.
That idea of a national Bitcoin reserve, for instance, If that ever happened, it's not just policy. It could fundamentally change how Bitcoin is viewed or even classified for tax purposes, right?
Yeah.
Could it become more like a currency, less like property?
It's a fascinating thought experiment. It would certainly lend massive legitimacy, a rising tide perhaps, but yeah, it would raise huge questions about its tax treatment. Would it get special status? Would long-term holding become even more favorable? It could rewrite the rulebook for Bitcoin investors. Pure speculation now, but shows how dynamic this space is.
And for people looking globally, there are places with very different rules, right? Tax havens.
There are, yeah. Places like the Cayman Islands, no income or capital gains tax. The UAE recently clarified zero tax on crypto. El Salvador made Bitcoin legal tender, tax-free.
What about Europe?
Germany has a popular rule: hold crypto for more than a year. Zero tax on gains. Short-term gains under €1,000 are also free. Portugal used to be fully tax-free. Now they tax short-term gains and crypto income, but long-term holds over a year are still exempt.
But the warning label on that is...
Laws change fast. Especially in this area. What's tax-free today might not be tomorrow. If you're seriously considering relocating for crypto tax reasons, you absolutely need advice from local tax experts in that specific country. Don't rely on online articles alone.
Solid advice. Okay, so after all this, how do people actually calculate these taxes? We've said DeFi is super complex, manually tracking every buy, sell, swap, fee, reward. That's it. It sounds like a nightmare.
It can be. Especially if you have thousands of transactions across multiple wallets and exchanges. Calculating the cost basis accurately, using the right method, that's the challenge.
You mentioned cost basis methods earlier. Can we recap those quickly?
Sure. There are a few main ways allowed, though the new 2025 rules might impact this. Traditionally, you had FIFO, first in, first out. Assumes you sell your oldest coins first, often the IRS default if you don't specify.
Okay.
LIFO, last in, first out. Assumes you sell your newest coins first, can be useful in certain market conditions.
And HIFO.
HIFO, highest in, first out. You sell the coins you bought at the highest price first. This strategy aims to minimize your taxable gains or maximize losses.
And the most precise one.
Specific identification, SPEC ID. This is where you pinpoint the exact units of crypto you're selling, perhaps ones with a high cost basis or ones held long term. But this requires absolutely meticulous, perfect record keeping showing which specific purchase lot you sold.
So FIFO is simplest, LIFO, HIFO are for optimization. SPEC ID gives ultimate control but needs proof.
Pretty much. And if your records for LIFO, HOFO, or SPEC ID aren't perfect, the IRS can just force you back to FIFO, which might mean a higher tax bill.
Okay, once you've done the math, where does it go on the tax return?
Your individual crypto sales, swaps, etc., the capital gains and losses get detailed on Form 8949. You list the asset, date acquired, date sold, proceeds, cost basis, and the resulting gain or loss for each one.
Sounds like it could be a long form.
It can be hundreds of pages for active traders. The totals from Form 8949 then flow onto Schedule D of your main Form 1040, summarizing your overall capital gains and losses.
And the ordinary income part? Mining, staking, airdrops.
That usually goes on Schedule 1, Line 8Cs, which is for other income. Or if it qualifies as a business, like we discussed with mining, it would go on Schedule C.
This sounds like where software comes in handy.
Absolutely. Crypto tax software is designed precisely for this. It connects to your exchanges and wallets, imports the transaction data, attempts to match up buys and sells to calculate cost basis using your chosen method, like FIFO or HIFO, figures out fair market value for income events, and then generates the completed Form 8949 and other summaries.
Saves a ton of manual work.
Hours, potentially days or weeks of work. Popular names you hear are CoinLedger, ZenLedger, Coinly, TokenTax, CoinTracker, Bitcoin.tax. There are quite a few good options.
But there's a catch. Right. It's not foolproof.
Definitely not foolproof. They're powerful tools, but not magic. They can struggle with classifying complex DeFi transactions correctly. They might mislabel self-transfers as deposits or withdrawals, messing up cost bases. NFTs can sometimes be tricky for them. You still need to review the reports carefully.
So the software helps automate the tedious parts, but you still need to understand the rules and verify the output.
Exactly. It's a tool, not a substitute for understanding, or in many cases for professional oversight.
Which brings us back to the professionals, especially for DeFi or leverage trading.
Yes. Professional help, like from a CPA or EA who specializes in crypto, is highly recommended to navigate the complexities, interpret gray areas, ensure accuracy, and help you avoid costly IRS penalties. For complex DeFi, margin trading, futures, that need increases significantly. They can spot issues the software misses, advise on strategy. It's often a worthwhile investment.
Okay, wow. We have covered a lot of ground today, from the basics, crypto as property, through all the taxable events, the non-taxable ones, the sheer complexity of DeFi.
And the looming changes, right? The increased IRS scrutiny with Form 1099-DA, the new accounting rules for 2025. It's a really dynamic environment.
Absolutely. And you add in the political discussions, the idea of a Bitcoin national reserve, it's core crypto, and its tax implications aren't going away. They're becoming more embedded in the system.
Definitely feels that way.
So for you, our listener, what's the bottom line? The landscape is shifting fast. Just holding crypto isn't passive anymore from a tax perspective. Every interaction matters. Understanding how selling, swapping, earning, lending, borrowing, how all of it hits your tax bill is just crucial now.
Couldn't agree more.
Which leaves us with a final thought to ponder. Knowing all this, knowing the rules are complex and evolving and scrutiny is increasing, how will you adapt your strategy? How will you use this knowledge not just to stay compliant, but to actively navigate these changes and ultimately keep more of what you've earned in this really exciting, but yeah, really complex digital economy?